Hey, welcome back to Two Super Guys Red Sox. How I'm doing?
And I'm Vinny. And man, oh man, I'm absolutely I don't know. I'm at like an inflection point here in the market. So Federal Reserve, Jay Powell just cut rates this week. We're looking at a couple more rate cuts, and where we are is kind of historic all-time highs. We're going to talk about what was in their projection and what that can mean for the markets going forward for the next year. It's pretty wild stuff. I'll say
Which,
that.
which I may disagree with. We'll
Okay,
see.
okay. Well, it's hard to argue with data, though. All right, this is literally what I see happening here. They just like launched a rocket tied to the SPY, and it's just going to pull it up. All right, this is literally what I imagine for the future. Money printer is going burr again. So this little blip here on the end. That's the little quarter point we got after having no rate cuts for like the last year, effectively, or 9 months, but approximately a year. So this is the dot plot. This is the every 3 months when the Federal Reserve meets, they'll actually vote on where they think the rate's going to be at these various time periods, and this is what they put out for their projections. Okay. First of all, notice there's quite a big kind of separation here where there are folks that say, like, yeah, we might have like one more this year. And there are folks that going like, nah, bro, we're going to like cut it like 1%. Like that's the rest of this year. That's the next like 3 months. Okay. It's a lot
Wait,
of disagreement
so
for short
that
time frame.
dot below 3% that's for 3 months from now?
Yeah. That's someone that thinks we're about to crash, probably, and they're gonna have to come to the rescue.
That
That's what
guy's
that person's
smoking
mindset must be.
crack. That is not, I don't know what, that's insane. That's unbelievably low. I gotta feel like, look, if you're on a board, all these people, they're all there. I mean, they're all conversing all the time. That this guy's, I mean, he's so far different than everyone. That's a lot. That's a huge difference.
You're saying everyone whispers about him when he walks into the room.
Oh,
That guy
100%.
again.
Absolutely. Yes.
It could be. Yeah,
100%.
absolutely could be. The rest of them are clustered, but still like that bimodal distribution a little bit, where you're seeing the two different groups. Those that think we're going to go aggressively cutting, and those that say like, maybe a little bit more, but nothing crazy. It's hard to predict, man. We've talked about it before. How like when the
Oh,
labor
it's
market
terrible.
breaks, it breaks fast, right?
Yeah. It also doesn't help that, the data was wrong for like 3 months. I think that was my
Pretty much
favorite stat
a
was we went
year.
from like, I'm going to get these numbers wrong. We did it last week. It was like 147,000 jobs and like, oh, no. 19,000 jobs. All right. We actually lost 13,000 jobs. It was like corrected multiple times.
Yeah. I know, right? So they also vote on a wide variety of other economic factors, right? So this one right here is GDP. This is their prediction for GDP, saying a slight downward trend into this year and then kind of bouncing back through the future. Unemployment, the slight increase going into like the end of this year, beginning of next year, and then kind of coming back down to baseline a little bit. And then PCE, we're going to talk about the two kind of separate, more detailed, if you will, graphs for those. All right. So the other thing to highlight here, if you've ever looked at this before, is this dotted line is where they were at the last SEP projection. Okay. So what this basically shows you is that they had a kind of a shift here, that the GDP was predicted to be lower just 3 months ago. So it's actually coming in slightly above where they thought it was going to be. Right. And then that's for this year as we come
Yeah.
into like the last 3 months.
Got it. Okay.
All right. Unemployment too. So this year, 2025, basically flat for where they expected 3 months ago. However, for next year, we saw a slight increase in their predictions for unemployment. I'm sorry, slight decrease in unemployment predictions compared to last year because the dot, like I said, was the 3 month ago time
Yeah.
period.
That one's
Right?
throwing me a little bit because, I mean, how can you say that when we literally just got the data? It just went up. All
I
right.
mean, look at the columns here though. These are very very small groupings: 4.2 to 4.3, 4.4 to 4.5, 4.6 to 4.7. Like this is really tiny little nuanced tweaks. This isn't like dramatic swings of like
No,
a
I know, I
percentage.
know. But like, I think what was that thing that was just like on Wall Street Journal or whatever? It was like the unemployment rate between 16 and 24-year-olds is 10.5%. So it's like, come on, it's all right. We'll
Yeah.
see.
Well, maybe ice cream shops, not so much this year. All right. PCE was another one. There was a slight shift. Okay. So the dot plot here actually had a slight shift down basically from last 3 months ago. More concentration is 2.9 to 3.0. This is for the headline PCE number, right? And then slight increase for next year. Okay. I don't know why my arrows are opposite here, but they are. Makes no
Two super
sense
guys.
whatsoever. Yeah, exactly. And then core PCE, slight shift downward here. You said compared to this dotted line area. And then for next year, you actually saw a slight shift up for core PCE. Right? How much of this is tariffs? It's hard to know. So this is the chart that you're going to see circulating a lot, talking about what just happened, right? So the Federal Reserve just cut rates with the stock market at all-time high. Right? This is a chart looking at the last times that has happened. Okay, and if you notice something here, basically for the next month, the returns are a coin flip: 50%, higher, 50% lower.
Yeah.
But if you want to slide yourself over, this is where stuff gets really interesting. Next year, 100% of the time, it has been a positive year. Yeah, yeah, with an average return of 13.9% or median of 9.8. I mean, look at some of these big chunky numbers in here. 20 and 30% returns. There's a couple of 20s. It's not that rare to see a 20% return after they cut rates at all-time highs.
Okay. So real quick,
Uh-huh.
let me get my soapbox here.
Yeah.
I disagree with it. Not the data. The data is, that's obviously correct. But the problem is I'm a little bit tired of how many firsts we have in the last 5 years. So we looked at these charts. We're like, dude, the SOM rule, every single time it's ever been enacted, it predicted a recession. So this is how it works. Failed. First time ever wrong. Okay. The COVID, we had the shortest recession in history with the sharpest V-shaped recovery in history. We just had the biggest jobs,
Revision.
revision in history.
Yeah.
I'm all of these things that have never happened. So many things that have never happened or are setting records in the last 3 years. It's ridiculous. So this should give me a lot of confidence. Now I'm just like, where do I buy puts? Because now I'm like, I'm not there. But I'm tired of it's almost like the historical data in today's environment it's just repeatedly failed.
Mm-hmm.
It's kind of odd.
No, I completely understand that. I mean, even it's much less degree, but when you're talking about those V-shaped recoveries, I was thinking about our Liberty Day or whatever they called it this year, the tariff day. Look at that on the chart now, going back. It's like a straight up V-shaped recovery.
100%. Yeah.
Yeah.
It's like the COVID weekly chart. It's just like a straight. It's just that's all it is, and then just straight up for 3 years. I get the data point, but man, I don't know. I'm maybe I'm too pessimistic. I don't know. In the comments, let me know if I'm too pessimistic. I'm tired of being at the mercy of firsts or records. I don't like it. It just sucks.
We're living in a new normal. That one might be another way of looking at it, actually, which is pretty bleak sometimes. So this is that after the Fed rate cut, this is the prediction for basically I'm looking at the rest of the year. So this is that CME Fed Watch tool, basically saying even at the next meeting here in October, we're going to get probably another 25 basis points because we're at 4% to 4.25 now. So like a 92% chance of pricing in for another 25 basis points at this next meeting. And then a further 80% chance for the one in December, saying, so there's a very good chance we see 2 more Fed funds rate cuts this year, is what they're saying.
Yeah.
As now.
I mean, yeah, I'm more worried about inflation. I get the use for it, but as of right now, even though the jobs market has shown some weakness, it's still great. But I get the risk. The risk is scary.
Well, this is an inflation touch actually here. So this is back to money supply, something we haven't looked at in a while. As the Federal Reserve was tightening, you saw money supply start to actually contract briefly. I don't know if you've looked at it recently, but it's no longer doing that. Yeah, it's back to growth, which does support the continued upward trend of the stock market. You're seeing more asset price inflation.
Great.
Yeah.
Solid.
Yeah.
Solid.
Very bleak for the future. But as a result of that, we're looking at this is the dollar strength index down 10% this year. So another reason why assets are inflating is because the US dollar has lost money compared to other currencies, right? Even more startling, if you go to something that is considered a better, store of value than other currencies, look at what has happened to gold this year.
Okay. I wonder if it's too late. Is it too late to get on this one?
Oh, I don't know. That's a different question, I would say, than I was prepared to answer. This is just me kind of wondering about, are we truly seeing the further divide of the haves and the have-nots in terms of people that own assets that appreciate either stocks or real estate starting to just pull it further and further away from those that don't have it. I think that's what we're starting to see, playing out here again, in this kind of post-pandemic realm. We saw it really, aggressively a couple of
Yeah.
years after the pandemic, and then we had a little kind of quiet lull where things are coming back into balance a little bit. But I think they're starting to see it pull away again.
Yeah, man. I got a little bit of a bad feeling here. I'm hoping. Okay, maybe people in the comments just say I'm overreacting. That would make me feel better.
Yeah.
I'll feel good about that. All right, all right. I'm feeling pessimistic. Okay, guys. I don't
All
like
right,
this at all.
guys.
I'm tired of the it's every single time it's ever happened. We're gonna have this. Well,
Yeah.
I got like 8 examples in the last 5 years. All right, guys.
Uncharted territory. But account balance is sitting at all-time highs. Okay, bro. I
Same.
feel warm at night when I wrap myself in my my investment accounts.
True. I do. I look at it every day. All right.
Here's the next one.
Later, guys.